A case was recently filed in the United States Tax Court in October of 2023 that I've been dying to do a presentation on because it involves a very small Schedule C and taxpayer, and it highlights all of the things that I stress with my clients on a regular basis to make sure that you're doing when you're filing your taxes and including Schedule Cs on them. It's very easy for certain things on your tax return to get the attention of the IRS computers and to put you in line for an audit. And then when the auditor starts digging into your books, it's very easy for them to disallow things or, pick apart your record keeping or lack thereof. And that can add up to very costly penalties and interest, even if you're a small taxpayer and don't think that there's much that they can find on you. Let's dig into this case a little bit. The taxpayer, number one, should have known better based on his resume. He was an employee of the IRS since 2008, and he had previously worked as a tax preparer. He also held 5 educational degrees, including a master's in business administration and a law degree. One would think that he should have known the tax law well enough and known the legal system well enough to avoid this, but he was just playing with fire on his Schedule C and got bitten in the end. His tax returns. He included Schedule Cs on his 2017 and 2018 tax returns. They were under the name of El Virtuoso Enterprise, and he listed on his tax return that it was a professional service business. This would have made any income on this business subject to Social Security and Medicare tax since it was a service business. His gross income in 2017, he only listed $6,000 of gross income and losses of $36,515. So his losses were over $30,000, or I'm sorry, his expenses were over $30,000 more than his income in 2017. And there was a similar situation in 2018. He only showed $4,000 of gross income in 2018 and showed a net loss of $40,124. In addition to that, he was taking the home office expense deduction, which there is absolutely nothing wrong with taking that deduction on your tax return if it's legitimate. I actually even have resources for that to help you calculate that and make sure you get that on your return. But before you take any deductions on your return, you should make sure that they're legitimate and that you're following the tax law to take those. The deficiencies that the auditor found on his return was underpaid tax of $13,062 in 2017 and 2018 underpaid tax of $12,351. That might seem really high based on the income that he had reported, but like I said, this was a professional service business. So not only was he underpaid on federal tax, but I'm guessing that there was also Social Security and Medicare tax in there that he hadn't paid in because he was showing the losses. And then the penalties on that for 2017 was roughly $9,800 and 2018 was almost $9,300. So in addition to the $25,000 in tax he owes for the 2 years, he's paying another $19,000 in penalties. What red flags triggered the IRS to look at his return in the first place? Number 1, he had a practice of reporting his expenses in round dollars. I always tell clients not to do that. I won't even report a return when the numbers are just in round dollars. If you send me over a piece of paper and say my office supplies were $2,500, my utilities were 400, that tells me that you don't actually have records for that. You didn't sit down and add up all your receipts, and it definitely tells the IRS computers the same thing, that you estimated your numbers, and if they go looking, they're going to find different numbers than what you reported. In addition, his expenses vastly exceeded his receipts, and he had losses for all years on his Schedule C since 2012. Anyone that does taxes will tell you the number one way for a Schedule C to get audited is to keep reporting losses every single year. The IRS takes the stance, which is an accurate one, that says if you're in business, you should be in business to make money. You're not in business to create a loss so you can get rid of your tax liability on other income. If you're not making income on your tax return, they could also determine that you have a hobby and that the income is taxable, but none of your expenses are deductible. This auditor did not go in that direction, but that could have happened to this taxpayer, was that he could have determined that it was a hobby and that all his expenses were disallowed because of that rule. If you're in business, you're supposed to be in business to make money. So you don't want to be showing losses year after year after year on your Schedule C. The audit findings, the auditor only chose 2017 and 2018 for an examination, which is typical. Normally, they'll come in and audit 2 years. Sometimes if they find a lot of mistakes, they'll go back and audit a 3rd year. If they find fraud, they can actually decide to go back 7 years. The auditor did in this one say he thought that there was fraud in this, so I think this taxpayer was getting off lightly considering the facts in this case and that the auditor didn't go back and try to audit prior years because this could have snowballed significantly if the auditor had decided to do that. During the audit, the auditor found unreported Schedule C gross receipts of $8,300 in 2017 and $7,200 in 2018. The way the auditor did that was he did a bank deposit analysis. What an auditor will do when they come in is they will take your tax returns and then they will ask for your bank statements. They'll ask for your business bank statements first, and then usually they will also ask for personal bank statements, especially if you're just filing a Schedule C, because they don't trust that all the money is not flowing into various bank accounts. They're going to trace it from your business bank account to your personal to see money is going back and forth. So that's why it's always important to, number one, keep separation of income and expenses, get a business bank account and use that only for business. And when you pay yourself, transfer the money from that business bank account to your personal and then use your personal for personal things. Pay all your bills from there. Don't commingle the income and expenses between the two. The auditor did allow this taxpayer to explain deposits that were made into the business bank account, but he had to prove that that was personal money and where that personal money came from. If he couldn't prove it, then the IRS, the rule is if you can't prove to them where it came from, they will deem it income and you will be taxed on it. It's always important to keep separate bank accounts and books and records for everything. After reviewing everything, the auditor came to the conclusion that this taxpayer had committed civil fraud. And it got to this point because the taxpayer was not cooperative with the auditor during the examination. He should have known better. He worked for the IRS. He had prepared tax returns, so he absolutely should have known how to handle this, but he just decided not to be cooperative. And they also said that he failed to supply accurate books and records. So that's part of the duty of being a business owner, whether it's an Excel spreadsheet, whether you're doing it pen and paper, or you're using QuickBooks, you need to have some kind of summary of your income and expenses for the year that ties back to your tax return and to your bank statements. This particular taxpayer did not have any of that. And he got hit with a fraud penalty, which is 75% of the underpayment of tax that is attributable to the fraud. Any of the tax that came from the underreporting or the non-reporting of income on his Schedule C was hit with a 75% penalty. So that's why those penalties were so high compared to the tax that the auditor showed that this taxpayer owed. What did this taxpayer do right? I couldn't find a whole lot other than he filed his tax returns on time, as far as I know. He did file tax returns, but everything else that I saw in this particular situation was raising red flags with the IRS. So, the bad here is what not to do and what I stress with clients on a regular basis. Number one, he showed losses every year. After 2 or 3 years of that, the IRS computers are going to start flagging your return and paying attention to that. His expenses were in round numbers. A tax preparer should question that, let alone is the IRS going to question that when they see round numbers everywhere on your Schedule C. And the fact that his expenses were significantly larger than his income every year, that shows that he was just reporting enough income to get something on the Schedule C the IRS is going to question, is there really a business purpose for all of those expenses on there, or are you trying to offset income from other sources to get out of paying tax? And he had no books and records. So when the auditor came in to try to justify what was on the tax return, the taxpayer couldn't provide him with anything to back up those numbers. And where it really got ugly for this particular taxpayer is that he, number one, didn't cooperate with the auditor, and he failed to timely respond to any notices that were sent. The IRS has very strict legal deadlines and times that they can respond to things and times that you have to respond to notices before it kind of escalates within the system. He ignored all of this, didn't timely respond to everything, which made this get worse and made the auditor less likely to work with him. And the reasons that he gave for not complying timely, he said that he was sick or he was traveling. And when the IRS went back and compared when he was traveling to when the notices were received or sent, they didn't jive. The outcome of this particular course right now is that it is going to court. The taxpayer is fighting the fraud penalties because they're so high. I don't see any way he's gonna get out of the penalties and interest. I could be wrong, but if he doesn't have any records to back that up, I would have told him, "Pay it and change your ways and not pick a fight with the IRS." He is fighting the fraud penalties because they are 75% and they are so significant. It's gonna be him against the IRS, and hopefully other people will learn from this and not follow in his steps. Books and records are very important. Separation of bank accounts is extremely important. And just make sure that what you are reporting on your tax return is accurate. And that if somebody does look at that, that you can justify those expenses and you're not just estimating and getting a tax return done very quickly and out the door because it can come back to haunt you.